our fourth speaker, John Forster, co-manages the specialist strategy, which includes Impax's flagship fund at Impax Environmental Markets, alongside Bruce Jenkins-Jones. He will now speak on the future of transportation, choosing the right investments.
Just here quickly to share a few perspectives on investing in this space. I think the introduction has done my kind of first bullet point for me, so I'll just jump straight into it. I think the first question for investors is, why does this matter? Why should I care about the electrification of vehicles? And it matters because we see a substantial disruption and transition underway that is shifting us from a world of internal combustion engines to a world of electrified vehicles. That transition is going to open up significant opportunities and also substantial risk for investors that we all need to get our arms around. The opportunities are around growth. This is a category that's currently less than 1% of new auto sales is in electrified vehicles, by which we mean plug-in hybrids and full battery electric vehicles. We see that going to anything up to 30 to 40% by 2030. So this is a category that's going to see explosive growth in a world where the economy is not really in particularly good shape, I would argue. So we want to have exposure to that growth story. But we also see a number of risks and knock-on effects for other markets as well. So on the one hand, there are implications for conventional automotive OEMs and the component suppliers that supply into that market. There are also kind of broader impacts in relation to the impact on oil over the longer term. So kind of a range of risks on this side of things that one needs to consider. And then finally, this is very early days. As I said, we're less than 1% penetration in EVs. And so we need to understand what are some of the main moving parts and residual risks to this explosive growth story. So I'll try and touch on as much of this as I can in a ridiculously short time of 20 minutes. So just quickly, this is not a new sector for Impax. We've been managing funds in environmental markets for 20 years. We've been looking at transport energy efficiency, by which I mean engine downsizing, adding turbos, and increasingly sophisticated pollution control, emissions reduction technologies over time. We've been following the nascence of the EV category, and what we became aware of was that it was going a lot quicker than people had previously expected. So we decided to do a deep dive where we engaged with a whole load of manufacturers through the whole value chain. We talked to the research houses, and we also engaged an army of keen, young, thrusting MBA students from Imperial College, who you might know does the best masters in environmental studies plus finance. So we put it all back together again, and would like to present to you some of the key findings that came out of that. So most importantly, we see a very strong confluence of factors that are driving change and growth in these markets. The origins are Dieselgate, which we all know was a real kind of turning point that's changed the whole future of transportation and vehicle markets. But it was more interesting for the reactions and the consequences of that event, which are very much working together as a kind of potent catalyst for change. On the one hand, there's been a lot of government policy changes. So in Europe, for example, the UK and France are looking at long-dated bans for the sale of new diesel and gasoline cars as of 2040. The EU, at a kind of higher level, is implementing aggressive CO2 reduction targets, which will be impossible without substantial uptake of electrified vehicles. If we look over further to the Far East, China is also implementing a lot of new policy, which we'll come back to in a minute. So there's a huge amount of policy change, and also this is happening at the same time that the economics of battery electric vehicles are substantially improving. We'll come back to that later on, but we've got line of sight of electric vehicles at $35,000 with a range of 200 to 300 miles. It's all starting to look like it makes real economic sense. And we'll come back to some of those issues. As I said at the start, there are still some uncertainties in these markets. One is about infrastructure, both the charging infrastructure and also the implications for the grid. I'm going to touch on it, but I think I'll leave that to the next speaker, Chargemaster, to kind of give you the detail on that. There are implications for tax because fuel, duties, road tax, these are all big earners for governments, and so we don't really know what the government response is going to be to the loss of those tax revenues. And there are also some residual uncertainties on used EV markets, residual values, etc. So we'll try and touch on all of these areas. In the interest of time, I'm not going to talk about Dieselgate, because I think we're all very well aware of the scale and implications of that crisis. But what it means, as I said at the start, is we see explosive growth in the EV markets that investors should want to have exposure to. This is a chart that's drawn up by Ricardo, who are an automotive consultancy. They talk to all of the governments, they work with all of the OEMs, and I think I'd say they have a pretty privileged perspective and view on the likely penetration and growth in these markets. So this is their chart. What you can see is a very wide range of forecasts out there over time. You can see the blue slice is the numbers that Ricardo feels comfortable with. And so this is where this explosive growth is coming from. 1% currently, something like 15 to 20% by 2025, and up to 30 to 40% by 2030. So that is what I call explosive growth. What it also doesn't show is the change in mix over time. So as the economics gets better, as the costs of battery technology come down, there's going to be a mix shift from hybrids towards full electric vehicles. So if you're exposed to higher content per unit in a more electrified vehicle, you're going to see even more outsized growth than some of the other players. So, as I said, very strong growth prospects in the market. We talked about policy as an important driver of markets, particularly in the early stage. And I think there's a lot of attention that's been paid to some of the announcements that's been made in the UK and Europe, but we feel maybe not enough attention is paid to what's going on over in China. And the short summary is it's a very important market for EVs, which is going to play a pivotal role in driving growth. The reason for that is a number of factors. First of all, it's the world's largest car market, comprises 24 out of the 84 million cars that were sold last year. So that's about 30% of the total market. Secondly, they're suffering from very acute and very problematic air pollution issues. You probably all saw the pictures of the smog over Beijing, but to put it into numbers, they had 600 to 800 milligrams per meter cubed of PM2.5 versus the WHO's recommended maximum of 25. So they've got severe problems that need to be addressed. But more importantly than that, they see EVs as a massive opportunity. I think it's fair to say that China never really managed to secure a place for itself on the global platform for internal combustion engines or conventional cars. They never really made it. So they really see an opportunity to establish a leading position in these markets going forward. They've already got a very good position in battery manufacturing, and they're looking to build on it from there. So what are they doing? They've got some very aggressive targets. They're targeting 7 million units per annum by 2025. That triangulates with a 20% penetration rate, which matches to the chart we were talking about earlier on. They're offering very substantial subsidies to the tune of up to $10,000 at a federal and state level. So very substantial subsidies in the context of the total cost of the vehicle. That's also skewed towards more kind of fully electrified, longer range vehicles. So they're really focusing on the area which is going to accelerate growth in these markets. And then finally, this is driving a substantial market. China is about half of the global EV market. It's about 500,000 units at the moment, and it's growing around 50 to 60% per annum. So they're going to play a key role in driving scale and economics for this global industry. So I think that's important to be aware of. People are quite generally cynical about policy and, well, are they really going to do what they say they're going to do? And we've been investing in Asia for most of these 20 years, and the short answer is China has a very strong track record of achieving and also beating original expectations and targets in these markets. So I think that's something to definitely pay attention to. Next area to try and touch on briefly is economics. And I think the starting point is to say that the economics, as I said at the start, are becoming much more attractive. With scale, the costs in the industry are rapidly coming down. The key area to look at, or one of the key areas, is battery costs. They were originally 2/3 of the cost of the vehicle maybe 5 years ago. They're now 1/3 of the cost, so it's come down a lot. We're currently at around 200 euros, we believe, which is about $250 per kilowatt hour. If you'd roll back 5 years ago, we were at about 600 or 700. So you can see how rapidly the costs are coming down here. And that is moving us rapidly towards cost parity, which is going to be a kind of multi-tiered event, but it's very important for long-term growth in these markets. There's quite a lot of different numbers to look at, but there are two main categories of cost parity. One is total cost of ownership, which looks at not just the upfront cost, but the lifetime cost of the vehicle, particularly over a lease of 3 years for the fleet buyers. Then there's purchase price parity, which looks just at the upfront cost. So what we're seeing is, with the pace of reduction of battery costs, we believe that total cost of ownership parity we see at around $150 per kilowatt hour, and we see that happening in the next 2 to 3 years. What that should trigger is strong purchases by the fleet buyers, who represent 1/3 to 1/2 of the market. So, with that volume will come further cost reduction, and which will in turn lead to further growth of these markets. So you can correct my numbers if I'm out of date later on, but that's kind of the way we see it. Longer term, a lot of people don't really pay attention to total cost of ownership, and they only really care about the upfront cost or sticker price of the vehicle. But we see with further technology improvements and scale, we see the purchase price parity at around $100 per kilowatt hour. And we see that happening somewhere between 2025 and 2030. So I think, it's all, whether it's the government targets or the technology cost, the OEM announcements, is all triangulating to the growth story and the penetration rates that we were talking about before. There are a number of known unknowns, but just very briefly, as I said, charging infrastructure needs substantial investment from where we are today. I think there's, my feeling and understanding is that the grid can tolerate a reasonable amount of EV penetration from this very low base. But as we get into the higher penetration rates, there's going to need to be substantial strengthening. So kind of issues around grid and charging infrastructure, which I'll leave to Chargemaster. I think there's no visibility on government response to losing what constitutes 5% of their government revenues in terms of fuel duties and taxes. So that's something that will evolve, whether they need to introduce a new tax, remove subsidies, something that may change the trajectory of economics in these markets. That's something to keep an eye on. And then this used EV market, particularly around establishing the total cost of ownership of EVs, and with a particular focus on what the residual value is. What's this car worth at the end of its 3-year lease? I think it's kind of relatively early days in establishing a history and really kind of nailing down the residual value of EVs. So time will tell. And I think linked to that, I understand some of the earlier presentations also talked about the second life for batteries. So that will have a knock-on impact on residual values in the space. And it's very early days in terms of establishing this second life and ultimately the recycling of the batteries. So these are all areas that we continue to focus on, but notwithstanding the uncertainties, we feel that it's a very interesting place to invest, and it's an area we've had quite a lot of success. So what do we like? What do we not like? We are cautious on single brand exposure, and particularly on areas where we see commoditization over time. Those are the kind of things we're most concerned about. We're a little bit concerned about the speed of this transition and current market expectations, but I'd say that's, for the long term, we still very strongly back this sector as an investment proposition. So what do we look for? We look for critical components in the supply chain. We look for broad market exposure, so companies that are designed in across the full range of OEMs, so exposure to the category, not a brand. We look for valuations that are reasonable. Nothing's cheap in these markets, but we're looking for reasonable valuations we can get our heads around. And we're looking for strong governance in all of our businesses and strong supply chain management. So I think everyone's talking about Tesla, so I'll mention the T word as well. We don't own it. And the reason for that is that it doesn't tick all of these boxes, in our opinion. So I'm not going to get into a detailed rebuttal, but particularly valuation is something that we can't get comfortable with. Trading on a PE of 122 times 2019. So we struggle with that. We don't think that's the way to invest in these markets. So, but what we do find is a variety of opportunities. So just to give you a quick flavor, when it comes to batteries, we don't own any of the lithium miners. I did meet quite a lot of them, but Impax is not a mining specialist, and I don't know how to value a mining asset. But also more fundamentally, in the long term, we don't really see a fundamental shortage of this material. So we didn't feel that was a good place to invest. We don't own any of the actual battery manufacturers, because if you look at margins and returns, they're pretty poor. What we do invest in is a specialist materials company who supply materials into the cathode of the battery. Some of you probably already know the name I'm talking about, but I'm not allowed to mention names. But it's a kind of leader in these cathode materials. It announced, to give you an idea of growth, it announced a trebling of capacity early last year. It then announced a doubling of the trebling. And then in the last couple of months, it announced an extension of that capacity expansion. So they only do that when they have visibility on revenues, and that just tells you how rapidly this is growing. Elsewhere in the vehicle, power electronics and other, we own a Swiss transducer manufacturer, which is used to measure current in industrial applications. They've got a substantial automotive business, and they're designed in across the full range of OEMs. They've got 50% plus market share. They have a 20% EBIT margin, 50% return on equity, and they are trading on 35 times PE. So it's an extremely high quality business. It's not cheap, but if you compare that to Tesla's 122, we feel that it offers good value for the long term. We also own a Thai power supply business, which is involved both in the onboard power supply on the vehicle and also the kit that's going into the charging infrastructure. They've got a good market position, trades on 15 times PE. So those are the Trust's main holdings. We have one more in this electronics and electrical. We look for companies that are selling sensors of all types that are going into electric vehicles. And we have other strategies that look at the electric motors and drives, just the nature of the businesses that are operating in those areas. So hopefully that gives you an idea of an alternative approach to investing in EVs, to look at these components, critical components with stronger market, more durable market positions, established, proven businesses with a more reasonable valuation. That's our approach to it. The Trust has something like high single-digit percentage exposure to these markets. We do see very attractive long-term growth in line with everything that I've said. There is a danger on timing and market expectations and some volatility on the way through. But I think that's why we see it as an integral part of our diversified portfolio within environmental markets, and that's what we try to offer our investors. So happy to answer any questions, and I hope that gives you a little idea of how we're going about it. Thank you.
Hi, you had a fairly smooth growth in electric vehicles, although on different trajectories. I'm just wondered if you see a jump in comparison with what might happen on petrol forecourts or fuel forecourts. Will there become a point where the number of petrol vehicles is not enough to support the cost of running a petrol forecourt?
I think in terms of the pace of penetration, I've said I'm cautious on the very near term, because the amount of product and the number of models that are available is relatively small. A lot of the new products coming out in the kind of late teens to kind of around the 2020 side of things. So that's the kind of near-term trajectory, likely maybe a bit slower than people are hoping, but then it will accelerate rapidly as the infrastructure comes into place, the technology cost comes down, and as we reach these cost points that we talked about earlier on. I don't have a strong view on when conventional fuel infrastructure becomes unviable, but I think we're a long way away from that. I mean, there's a lot of sunk cost in that infrastructure, and we are looking at even in 2030, if 60% of the market is still internal combustion engine. If you looked at the proportion of the car park which is still needing that fuel, I think there's still going to be a long-term future for that infrastructure, at least until what are we talking, the middle of the century or something like that. So that would be my stab at that. But I think ultimately it's quite hard to see a future for those technologies. So that is a tail risk that we are definitely considering when we look at conventional auto exposure. Yeah.
Perhaps I can ask a question. So you mentioned what the grid can tolerate now, and there will come a point when it will need to be strengthened. I mean, what do you think the limit will be before that strengthening has to come in? What market penetration of vehicles?
I don't have an exact number for that. I think ChargeMaster will probably give you a much better number than I can. But I think maybe possibly up to 10%, that kind of penetration rate from where we are. I think what are we talking? There is 40% of the population does have access to charge vehicles at home. I think the current charging infrastructure at 7 kilowatt hours is enough to charge a vehicle overnight. I think that's what you were saying earlier on. So I think there's enough people that can charge at home and are okay with that kind of timeline for charging that will give us a kind of first start, and the rest will come over time. So I don't have a firm number, but that's just a kind of a feel for it. Yeah.
How do you see trends in vehicle ownership versus a lot of companies moving towards this kind of idea of mobility rather than owning the car itself?
It's an area that we are starting to have a look at in connection with autonomous vehicles as well. But I think the short summary is that we feel autonomous vehicles are quite a long way away. Our feeling is that the technology will be ready a long way before the regulation is ready. And establishing liability, all of these kind of key issues. So getting that all sorted and then managing this transition to a mixed fleet of autonomous and driven vehicles and shifting towards autonomous is going to take a very long time. So I think in the very long term, models like shared ownership or kind of transport as a service will take on, but we don't see it really impacting in the near future. That's my view. It's a shame because it really should, right? It's the most underutilized asset that we all own. Yeah.
Just on your comments on Chinese policy, to an extent, I think we saw in solar, in the solar energy world, Chinese policy being directed both to dealing with the environment, but also being an industrial support policy, which I think to an extent left a very commoditized market, which was good for consumers, but maybe not for the industry. Do you see that as a major threat in the automotive space?
Commoditization of EVs? Yes. I think there are a lot of players who are working furiously to launch product. So it is a market that we see as becoming much more competitive, and that's what's driving our preference away from single brand in an area where we see commoditization, and towards components and parts of the supply chain where there is enduring value and a kind of technology value. So. But there is a risk of commoditization in the broad industry, so definitely, yeah. I hope that answers your question.
Yes, indeed, yes.
You didn't mention the semiconductor space. Do you have a view on that?
We do, so within this kind of electronics and electrical, we do have funds that invest in the chips that are used for managing information and current around the drivetrain. I think there's definitely a very clear value in the technology, getting back to what we've just discussed about. There's also, a pretty compelling story in terms of content per unit growth, particularly as one transitions towards more fully electrified vehicles. So it definitely ticks all of the boxes, and there are a couple of key companies that we invested in that area as well. So sorry, I thought I was running out of time, but it's definitely an area to look at.
I was wondering, you mentioned you're positive on China. How do you see, do you have any concerns about, political risks in other emerging markets affecting this industry? I mean, for example, you're in Africa with cobalt mining. Any risks there that you see?
Yeah, I mean, I said when I said what we're looking for, I mentioned governance and integrity of the supply chain. So we are very focused on making sure that our companies are doing the right thing and are not exposing themselves to risks in relation to cobalt, for example. But when it comes to that risk, we do see it being moderated over time, not least because the battery market is transitioning away from cobalt. So if we say NMC is the predominant technology within lithium ion, at the moment, originally it was 3-3-3 between NM and C. We're transitioning towards 8, 1, and 1, so kind of high nickel and very low cobalt. So as that transition happens, the exposure to that risk will moderate. So we see it as manageable in that context. When it comes to policy risk, the risks occur when, in my experience, when you're exposed to only 1 or 2 markets and whether they might change their mind. I think the political backing and will to make change happen is so broad across countries, regions, that I just don't see it being derailed at this stage. Trump over in the US, our good friend, has definitely been trying to kind of row back on some of the fuel efficiency standards in the US. But California's expressed its determination to press on and hold tight to its existing standards. And the automotive OEMs are not going to make different cars for different states. So those are some of the risks, but nothing that we feel prejudices the long-term growth prospects, not least because the economics getting so much better. That's what we're looking for, is pure economics rather than a political driver over the long term.
I was interested in your comments on the miners.
Yeah.
I mean, if you look at lithium mining, for example, there's basically a 2-tier cost structure with the brines versus the hard rock. And from covering heavy industrial sectors over the years, one thing I've noticed is that If you get the companies on the right part of the cost curve, they can earn a very good return on capital over the cycle. And if you pick them up in the right part of the cycle, you can get them for very attractive PE. So I was just interested on your comments about, are you ruling out the lithium miners permanently from your fund? And also, I don't think, but what are your thoughts on the cobalt sector as well?
When it comes to lithium, as I said, part of it was just a recognition that having met 5 or 6 of them, I just didn't know how to value a mining resource. And we tend to invest only in profitable, proven, established operating businesses. So looking at businesses that are a bit of paper and some engineering reports, I was just not comfortable with that. I do believe that if you're on the right place in the cost curve, you can make some kind of returns on capital. But I do believe that in commodity markets, people's idea of an acceptable return is very variable. And so, you might find yourself making a lower return than you feel is justified, even at an attractive part on the cost curve. So that's just my perspective on it. But as I say, there are 2 reasons. One is our lack of experience in mining businesses. So I wish them all the best. I hope they get there. Yeah.
Thank you, John.
Thanks very much.
Okay.
Thank you.